I am Paula Ford, and I have been in banking for over 30 years. And I have spent the last 8 of those years at a credit union. And I will just say that credit unions are a little bit different than banks. I personally have both a credit union relationship and a banking relationship. So there are benefits with both. I'd like to thanks to the Manlius Public Library for assisting today with this presentation. It is Understanding Credit, and it's a very consolidated presentation just highlighting on the most important things. So I'd like to start with the 3 major credit bureaus in this country. They are Experian, TransUnion, and Equifax. But the most important piece on this slide is the website, annualcreditreport.com. It's the only federally approved site that will allow you to go in and view your reports annually for no charge. You could pull all 3 at once. You could stagger it so that you're looking at the Experian in January, the TransUnion in June, and the Equifax in December, just to keep an eye on those reports and to make sure that there are no errors. If you have a common name, sometimes something will show up that's not yours, and you can dispute it right at the annualcreditreport.com site. Sometimes it is your unpaid parking ticket or your unpaid medical bill that is in fact yours that got overlooked, but you will want to know about that right away so that you can get it paid and taken care of. It lingers on your report for 24 more months, but it is something that you want to eventually resolve. I will say this, you should type that address into your browser from a trusted computer. So you would go up to the top and put in the www.annualcreditreport.com and make sure that you're pulling up the proper site. You will give some sensitive information like your name, your social, your birth date, your address. You could be, sometimes the identity theft things, there are scammers that will send you an email or a Facebook Messenger or even a text message telling you to check your annual credit report, but it's not truly their site. That's why it's important to be at a safe computer and to type that address in yourself. You will answer some multiple choice questions, like maybe a county that you resided in or owned property in, a car that you may have had a loan on. Sometimes the answer is D, none of the above, but you do need to get all those right to get in to see the report. You will not see a score, like whether you're a 680 or a 720 or an 800, there won't be a number attached. It's just the credit report itself and all the lenders that you've ever had and how timely you've been with payments. So that's that. This slide is the one that I will spend a little bit more time on because it wasn't until 8 years ago when I became an underwriter that I understood what went into calculating the score and what we as consumers could do to improve it. So I'm going to start with the biggest one. It's quick, it's easy, it's self-explanatory. 35% of your total score comes from payment history. As long as all of the loans and the lines of credit that you've ever taken out, you're always paying them on time and you are never more than 31 days late on anything, that is going to be the highest contributing factor to your score. 30% of your score is determined on something an underwriter calls capacity. So that means how much of your credit that exists in the form of lines, like a credit card or an overdraft line of credit that's hooked to your checking account that protects you from overdrafts. Maybe it's a home equity line of credit. So that comes with a cap or an amount, but you borrow from it, you pay back, you borrow from it, you pay back. It's open-ended. There really isn't an end date in these types of credit. But let's say you've got a couple credit cards, an overdraft line of credit, maybe a personal unsecured line of credit that the bank or credit union gives you checks on. So let's say they all equal $100,000 that you could potentially charge. If in all of those accounts, that $100,000 that's available to you, let's say you're in a good position and you owe $10,000 on all of them combined, that means you have $90,000 that you could use. That is something an underwriter sees as non-risky behavior, and it will have a positive impact on your score. So if you are carrying credit card balances and just making minimum payments or maybe a little more than, and you do have the money in a low interest-bearing savings account that you could pay those down, it will help you. The other side of that coin is maybe you owe $90,000 on those accounts that would let you charge up to $100,000. That means you're at 90% capacity. You only have $10,000 in which you could spend or borrow from freely. That is more on the side that will hurt your score. So that's something that I didn't know, and it's useful for you guys to know, because if you want a higher score for a better rate and you're in a position to pay down on some of those revolving or lines of credit, do so. 15% is determined on the length of your credit history. So my example here is that I have a 21-year-old son and an 18-year-old son. And knowing what I know, I got them both small credit cards. $1,000 is the limit. So for one boy, it started in 2018. That's when his credit history began. And the other boy started in 2020. So maybe 10 years from now, they're in a higher income position and they get offered a $30,000 line of a credit card from maybe Delta Airlines that's going to give them miles and free trips, and that becomes their preferred card. It is still a very good idea to never ever close out that $1,000 card that they took out in their youth, because it just helps the length or the age of all the credit accounts that are in good standing. Which leads me to 10% of your score derived from new credit. So let's say you are out shopping for a special occasion and you visit 10 stores in a day. Every single cashier, it's their job, it's their goal to try to sell you that store's credit card. And they are aggressive and they're trained not to take no for an answer. And if you cave and you walk out that day and you've got 7 new accounts, that just doesn't look good. It drops your score. It reduces the length of your credit history. So my advice here is to practice your graceful no and just be firm and indicate to that cashier, I have preferred cards. No, thank you. You did a great job. I'm all set. Thanks anyway. The tip here is to only take on new credit when you absolutely need it. And there will be times that you do, but you don't want to walk out after a single experience with 7 new accounts. Your score will take a dive. And then the last 10% is a credit mix. What that means is you have a combination on your credit report that includes installment loans. Those are usually fixed rate loans. The monthly payment is always the same. It's predictable. It lasts for, and the way you see it is 3 years is 36 months, 4 years is 48 months, 15 years is 180 months. So you make your monthly payments and then it's over when the time is up. Those are installment loans. And then the other is lines, the revolving, the credit cards. So if you have a blend, that is going to contribute to 10% of your overall score. I taught this class with a coworker, and she indicated her significant other just sold his house and paid off and closed a mortgage. And that's a wonderful thing to do. It's a great position to be in. But Discover was sending him FICO scores every month in an email, and his credit score dropped by 60 points. You can't lose any sleep over that. No debt is the best debt, but it just meant that all he had left was credit cards only. So just be aware of it. It's a small percentage of the score. And if you don't have to have loans, that's okay. Congratulations. And then how do you rank with the rest of the country? I'll just say a few things about this, knowing what I know. At our particular financial institution, 640, for some reason, is kind of a magical number because we find if people score 640 or higher, the loans are sometimes a little easier to get. If they score 639 or lower, we ask for more things. Sometimes they need a co-borrower. Sometimes they need to bring us some pay stubs. Sometimes they need to prove their address. You know, they need to have direct deposit and automatic payments. So each institution will be different, but I'm telling you, the higher your score is, the easier the loan will be, the cheaper it will be. You'll be paying a lot less in interest back to that financial institution. Each creditor has different rating structures. For us, 780 or higher is what we call tier 1 credit. That's the best. That is going to get you the best rates overall. Some institutions that I worked at in the past called it P paper. Whatever their unique term is, you really don't need to know. You just know you want to score as close to the 800 as you can. But you'll see there most of the population is coming in between 750 and 799. Let's go to another interesting factor. Not just getting loans is when it matters, but these are the places that are legally allowed with your permission to look at your credit score. Of course, anytime you get a loan, there's the lenders. Landlords, if you're renting, like my sons want to get an apartment, they will likely sign off on some paperwork that allows for a background check. It's going to make a difference sometimes with a better score. It shows how fiscally responsible someone is. Insurance companies, it could affect your premium. If you're scoring on the higher end, you will pay less in premiums. And if you are risky with a lower score, you may find yourself paying higher premiums. And the last is potential employers. Again, these places need to get your permission, usually with a signature, to do a background check. But if it's down to you and one other candidate and you're in the 800 range and your competitor is 600, that could be the determining factor in who gets the job. So those are the places that can look. And this really does wrap up and conclude the presentation. I'm going to share my email address, and I think that Bill from the Manlius Library will help get it into the YouTube presentation. If I didn't answer everything today, because this was a very condensed version, or you have additional questions, my name is Paula Ford, and my email is paulaf at AmeriCU.org. That's PAULAF as in Ford at AmeriCU.org. So I thank everybody for tuning in. I hope I helped answer a few questions, and I thank you all for your time.